Hey everybody, welcome to Mortgage Today for Monday, October 2nd, 2023, and oh, what a day it was. UMBS were down 30 basis points bright and early again this morning. S&P futures were down 7.25 points. The 10-year Treasury yields jumped at the start of the new month and quarter, possibly due to the averted government shutdown and new month trading. Bonds had corrected lower at the end of last week, but have since popped back up before this morning to the higher for longer trend. This suggests that investors are actually now starting to price in higher interest rates for a longer period of time. The market is likely to take cues from the economic data this week, and now they'll actually get it, because otherwise the government shut down, we wouldn't have gotten that data. The government came up with a deal to prevent the shutdown. The deal funds the government through early November, but the deal does not include any spending cuts. However, it didn't include any further aid for the Ukraine either. We got the ISM manufacturing PMI, which came in at 49 on a forecast of 47.49. It was 47.6 previously. Companies are still managing outputs appropriately as order softness continues, but the month-over-month PMI improvement in September is a clear positive. Demand eased marginally with the orders index contracting, though at a slower rate. New export orders index continuing in contraction territory, but with marginal increase, and a backlog of orders index declining. The upcoming week, like we said, will be dominated by the employment data culminating in the jobs report on Friday. The consensus is that the economy added 160,000 new jobs in September, and the unemployment rate ticked down to 3.7%. We also got news that Apartment List reported showing that rents decreased 0.5% in September and are now down 12% year over year. However, this is on new leases, not renewals. When you blend in renewals, they're down only 3.1%. Average hourly earnings are expected to have risen 4.3% on a year-over-year basis. The month and quarter ended on Friday, and it was, to put it mildly, an awful month for bonds and MBS and therefore mortgage rates. The Fed's restrictive monetary policy has tightened financial conditions by design, and the 30-year fixed-rate mortgages closed the month at nearly 7.5%, roughly 30 basis points over the last 30 days. The stopgap bill that averted the government shutdown was worth some instant selling on the bond market. It was not given that this would be the reaction, as past examples have gone both ways. We also can't rule out random trade flows associated with a changeover of the month and the quarter. Selling intensified after the 10 a.m. ISM manufacturing data, with losses peaking just after the noon hour. 10-year yields hit a new long-term high at 4.701. And MBS lost just over a half a point. Like I said, UMBS ended up down 53 basis points at 98.09. So at 98.09, we are just barely above this Fibonacci line, the thick blue retracement line right there that is at an ugly, ugly range. We also got news that Rhythm Capital, the parent company of NewRez and Caliber, announced the purchase of specialized loan servicing and other assets from Computershare for about $750 million. The deal includes about $136 billion in MSRs.